To conclude this section, let's examine one of the essential findings of the examples we elaborated on. Hence, we are going right to the heart of what makes banking both useful and fragile. We will unpack the two complementary concepts of maturity transformation and liquidity transformation and bring them together into their common ground. To briefly recap what is meant by maturity transformation. Banks borrow short-term, that means deposits and wholesale funding, and lend long-term, that means mortgages and business loans. This bridges the mismatch between savers who want liquidity and borrowers who need stability. In other words, savers want liquidity to withdraw at any time, while borrowers need stability to repay over many years. Banks sit in between, transforming short-term savings into long-term credit. Banks earn the maturity spread, the difference between low short-term borrowing costs and higher long-term lending rates. This is a key source of profit. And on the other hand, liquidity transformation. Banks fund illiquid assets like loans, mortgages, securities that cannot be quickly sold, with liabilities, meaning deposits and repos that can be withdrawn on demand. This creates the appearance of full liquidity for depositors, even though the bank's assets cannot be liquidated quickly without losses. Or in other words, depositors perceive their money as instantly accessible, so liquid, even though the underlying loans or bonds are not. Together, one focuses on time horizons and the other on marketability, but they are inseparable in practice. How are they interrelated or intertwined? Maturity transformation creates liquidity transformation, meaning lending long-term inherently means holding illiquid assets. Funding with short-term liquid liabilities automatically creates a liquidity mismatch. Liquidity transformation intensifies maturity risk. If short-term liabilities are withdrawn en masse, the bank must liquidate long-term assets early, often at a loss. So the two are different lenses on the same underlying fragility. Going forward, how do maturity and liquidity transformation reinforce each other? Maturity mismatches make liquidity shocks worse. The longer the maturity of assets, the more painful it is to sell them early. Liquidity mismatches make maturity mismatches dangerous. The more liquid the liabilities, like demand deposits, the higher the chance of a sudden run. Combined, they create run risk, a self-fulfilling panic where withdrawals force fire sales which destroy capital and fuel further withdrawals. As we heard in the previous lectures, this leads to feedback loops. To quickly recap, this dynamic produces a vicious cycle. Depositors or funders lose confidence, they withdraw short-term funding. Banks must sell long-term illiquid assets to raise cash, and fire sales push asset prices down, leading to losses that erode capital. Confidence erodes further, entailing more withdrawals. This is essentially the liquidity spiral that we observed in the GFC. What are the commonalities between maturity transformation and liquidity transformation? Both are central to banking's social function. They are matching savers' need for liquidity with borrowers' need for long-term capital. Both are sources of fragility. They create a systematic risk since confidence loss can trigger runs even at solvent banks, and both rely on confidence. As long as depositors believe their money is safe and liquid, the mismatch doesn't matter. Once confidence evaporates, both maturity and liquidity transformation unravel at once. In short, maturity transformation and liquidity transformation are two sides of the same coin. They are deeply intertwined. Maturity mismatches make liquidity mismatches inevitable, and liquidity mismatches magnify the risks of maturity mismatches. Together, they enable banks to provide credit and liquidity to the economy, but also create the potential for destabilizing feedback loops and systemic crisis when confidence breaks.